according to the Reserve Bank of Australia, their official announcement is inflation is easing but has been doing so slowly than previously expected and remains high. The board expects that it will be some time yet before inflation is sustainably in the target range. While recent data has been mixed, they have reinforced the need to remain vigilant. Welcome to the Urban Property Investor. I'm your host, Sam Saggers, here to help you crack the code of real estate wealth. Today's show, we're going on a microeconomic journey. Yes, if you like the idea of understanding where the economy's headed and rates are going, then, well, today is your lucky day. We're going to dig into what is really happening in our economy and discuss the future outlook of where real estate and, of course, interest rates may land. So, hey, welcome to the show. Play the show in double speed if it's your first time tuning in. And, of course, if it's not your first time tuning in, you know the drill. You can do anything you want. Play the program in double speed, go back in time, listen to past episodes. You can, really unlock real estate treasure by navigating the past 200 plus episodes of the Urban Property Investor podcast. I'll leave that with you. There is so much to learn and discover by going back in time. But hey guys, I hope all is well. Today I thought we should tackle some questions around the economy. I'm getting a few DMs, if that's the right language, on where I think the interest rates will go, what next for the Reserve Bank, what will those cheeky four horsemen do next? Of course, we've had the federal budget roll out and we are going to have an election next year, and much of the world is headed for election as we kind of speak or over the next 3 months. So it's going to be very, very interesting to see at a global level what inflation has done to the world, whether creates a new narrative politically from people feeling a little bit sidelined from the economy. But certainly over June, the RBA made their announcement to leave the interest rate on hold. And of course, that was the 5th consecutive rate decision by the RBA to leave rates where they are, which of course followed 13 rate rises starting all the way back in May 2022. And of course, I guess the backdrop of leaving rates where they were or are has been a low jobless rate, a level of employment which is ultimately not falling, i.e. it is every time the economy shreds some jobs, they are quickly put back into the economy. So the participation rate is at near all-time records. But inflation, that sneaky little thing, is stubborn. And we said this might happen, didn't we? When you go back and listen to past episodes, I said it's going to be very, very difficult for inflation to go back into its bottle at a 2% inflation rate. We may be living now in a period where the new normal is 3 to 4% inflation rate. And of course, what that means is your wealth needs to grow by 3 and 4% to keep up with inflation, which is basically keeping up with status quo. And of course, to make more than inflation, inflation-adjusted returns is the big job of property investors. And of course, housing, food, fuel, it's all pretty much higher at the moment. and certainly more significantly much higher than really pre-COVID standards. But it's also fair to say there's some price gouging going on. Let's face it, when it comes to some sneaky players in the economy, they've sort of realized that inflation is a tricky thing to measure at the best of times. And so other than obviously skyrocketing rents because no one has a home to live in and house prices still seemingly on the rise, then you've got obviously a bit of price gouging going on. And we do see that certainly in the staple food section. I think the Australian Competition and Consumer Commissioner has come out and sort of poleaxed Coles and Woolworths for price gouging in a time where effectively, inflation is rampant and really what a lot of businesses have done has used that inflation to their advantage and sort of put prices on unnecessary things up. So there is an element of price gouging out in the economy right now, which may or may not actually create an impact on the inflationary numbers. I know by way of example, certain industries are putting up wages exponentially, probably arguably price gouging certain wages in the economy as there's shortages they're manipulating. And it's happening out there. But obviously an economy can go from an inflationary environment where we're at the moment to deflation, which allows for excess demand to come out of the economy. And I guess when we look at where interest rates may be headed into the future, there are a few variables which we need to discuss. According to the Reserve Bank of Australia, their official announcement is inflation is easing but has been doing so slowly than previously expected and remains high. The board expects that it will be some time yet before inflation is sustainably in the target range. While recent data has been mixed, they have reinforced the need to remain vigilant. So there's a little signal from the RBA from June 2024, the inflation path of interest rates that will best ensure that inflation returns to target in a reasonable time frame remains uncertain. This is what the board's saying. So in other words, they don't know what's going on, which, is unsurprising for the Reserve Bank of Australia, isn't it? We obviously had the period of Philip Lowe just basically getting the whole of COVID wrong, and now we're kind of dealing with it. But if you want to sort of break down the different scenarios in the economy, obviously you've got an inflationary period where we sit right now, where the inflation rate is above the targeted rate. So right now, we're sort of sitting in that circa 4% inflation zone. So the economy can go in a couple of directions. It can go to a soft landing, which for the economy, a soft landing is that headline inflation number that the Reserve Bank wants, which is like 1 to 2% inflation on costs of a basket of goods. Or the economy can go into a period of basically zero growth, yet inflation, or a controlled, stabilized balance sheet recession. You can actually deflate the economy and tip it over the edge. The problem Australia has is it can't reach really a recession at this point because it ultimately brings a lot of population into the economy to prop up that recession narrative. And obviously recession's a bit of an ugly word. A lot of people hear the word recession and run for the hills, but ultimately a controlled balance sheet recession's not such a bad thing economically. It just corrects any excess demand in the economy. Obviously, you can have a deep, dark, terrible, horrible recession, 10, 12, 13% unemployment. Don't think anyone wants to see that. Or you can have stagflation. Or actually, you can go into a inflationary environment from an inflationary environment. And really, I guess it's very important that the Reserve Bank monitors inflation, because obviously inflation is pricing power, and when people run out of pricing power, they really have no money in their back pocket at the end of the week, which is tough. People are doing it tough out there, and there's certainly an have and have not world that we are seeing unfold. That is for sure. It's like two economies at the moment. People with no issues with the inflationary environment, and people with a lot of problems off the back of the inflationary environment. So rates are on hold again. The cash rate is, at the time of recording, 4.35%, which again is probably consistent with where the economy actually needs to be. And certainly when you start to look at 10-year government bond rates, we can see that really the decade ahead, we will probably live in an environment where the cash rate has a 4% in front of it. It may dip down off the back of really the situation where we've induced interest rates up, which has caught the market by surprise. But ultimately, I think probably we're in a decade where the inflation rate will be a lot tougher on the marketplace. And of course, that means if you're disinvested, you're in trouble, because you need pricing power assets that can keep up with inflation to make sure that you're going in the right direction in life. Most wages are not keeping up with inflation. And of course, that means you need a wage plus investments to beat inflation. It's really the principle of being an investor, is to make sure you don't get wiped out by the cost of living. Obviously, the federal government sees a real divide in the economy, because their federal budget was all about helping the marginalised tenant marketplace with welfare. The average Commonwealth rent assistance rental scheme has had to rise, and of course, you're getting people at the bottom end of the market being swallowed up by inflation. Of course, now the government handout sort of come to support that end of the marketplace. But if we actually look at headline annual inflation since the last RBA report, it's has risen by 3.6% over April. That followed a 3.5% increase over March, with a headline underlying inflation of basically 4.1%. So it's well above the target range. And of course, the significant contributors to that 4.1% have been housing, which has gone up in value by a collective 4.9%, food, which has gone up in value by 3.8%. But was Coles and Woolworth cooking the books? Was there price gouging going on? Is that inflation real, or is it basically company-led inflation? So the watchdog's looking into that, so we may see a reprieve next time around. But let's wait and see. Fuel is up 7.4%, and again, we are still significantly higher currently at an inflation level than the RBA's targeted range of 2 to 3%. So obviously, if things go up by around 4% per annum year on year, that can obviously leave a lot of people in society behind, and that is one of the drivers as to why the Reserve Bank of Australia wants to bring interest rates down. Interesting enough, US inflation is sitting at 3.6%, Australia inflation 4.1%. However, the US interest rate is 5.5% against an inflation of 3.6%, while the Australian interest rate is 4.35% against an inflation rate of 4.1%. So the spread in the United States is a lot wider from what they're paying in their interest rates to a much lower inflation rate. And of course, the interest rate differential is an important number for Australia because it will determine where the Australian dollar goes. And arguably, the Reserve Bank of Australia may need to push interest rates higher to make sure the Australian dollar is not too weak against the greenback. And certainly at the moment, if you're traveling overseas or buying goods and services from overseas, the Australian dollar is circa 65 cents, and it's kind of nice to have it around 75 cents. But hey, inflation's also tracking oil, and it's probably fair to say that the two are running side by side. Inflation came down when the oil prices came back, but now oil prices are starting to slightly drift up again, and we're starting to see inflation drip up again. Obviously, oil is hard to forecast because, Joe Biden could release some of US world reserves onto the marketplace and dramatically basically lower the cost of oil. He could make that decision tomorrow morning, and literally the cost of oil would flow down and become less expensive. But certainly anyone who's been to the Wowser lately probably sees the true cost of what it is to fill up a car. And certainly, well over $2 a litre for the most part to fill up your motor vehicle. And of course, that's a lot more than it was, say, 2 or 3 or 4 years ago. 4 years ago, it was $1 a litre. Now it's basically $2 a litre, give or take. And of course, that in itself is inflation right there, folks. So that's not reason to think about investing. I don't know what is. But certainly the labour market has remained quite resilient. We have not seen the economy shred jobs in droves, and we certainly are not seeing any sort of panic signs that the interest rates are killing off a large proportion of business, because despite a lower jobless rate in May, we have rebounded and we have put on something like 38,000 jobs over the last month. So again, the participation rate is basically at a record high, and states such as New South Wales and Western Australia are responsible for a large proportion of new job creation. And of course, when jobs are created, obviously, and when there's a low unemployment level, there's obviously pressure on wages growing. And of course, wage growth is inflationary. So we are seeing across the country pretty high, or low levels rather, of unemployment. Now, when I left school, unemployment was like 12%. Now we're talking basically around 4% unemployment, which is ridiculously low. Sydney's unemployment rate is 3.9%. This time last year it was 3.4%, still very low. Melbourne's unemployment rate, 4.3%. This time last year, 4%. Brisbane's unemployment rate, 4.5%. This time last year, 3.7%. Obviously, Southeast Queensland's getting a lot of internalised migration, so maybe pushing up that unemployment rate a tad. Adelaide, this time last year, the unemployment rate was 3.8%. Now we're at 4%. And Perth, stellar performance. This time last year, the unemployment rate 3.4%, currently 3.5%, basically virtually the same, seasonally adjusted. So we can see that despite there being certain jobs shredded in the economy is fairly well resilient on where we are at. And of course, wages are still growing, probably not growing compared to where they should be when measured going back, say, the last 15 years. Wage growth has been very, very low compared to inflation. But certainly we are starting to see the private sector pay more for workers and offering up annual wage increases, which a lot of them are legislative wage increases. Wow, there's a word for you, legislative on a podcast. That's a difficult word to pronounce. But hey, wage surges have happened, and we're certainly in a better place than we have been going back all the way to circa 2008. So you could arguably say wage growth has not been as high since 2008, sitting at basically the headline inflation rate of 4.1%. Retail figures are starting to be a little bit woeful, even though elevated compared to, say, a couple of years ago. We are starting to see excess demand come out of the economy. And really, excess demand is really a measurement of like what else can people spend and what else do people want. And I think what we're seeing with retailers is quite accurate. People aren't, enthusiastic to go out and spend, another $600 on a pair of Nikes they don't need, or go to a restaurant and drop $500 on a meal they don't need. So there is a level of excess demand which is naturally disappearing from the economy. And of course, that means that inflation from that excess demand is not there now. People aren't, frivolously spending like maniacs that they're at the casino and they've just won the lotto and they're going out and spending on everything. And interesting enough, house building costs are starting to pull back a bit, which is what we want to see. Certainly off a market high. And of course, the canary in the coal mine with any economy is construction workers. If you're not growing in your economy, you're not constructing anything. But certainly a lot of work still out there for construction workers. Obviously, a mandate to build 1.2 million well-located homes, the Olympic Games, there's big mining projects, and then there's some big state government projects around Australia, mega projects if you like. So certainly we're not seeing any form of market obliteration in the job space. And generally when you do, you start to see the construction worker market fall apart. And we're certainly not seeing that. But we are seeing the cost of building materials start to come back a bit, which would be nice to see things start to become more affordable in that space. So the economy overall is growing, but at a slow rate. And the current estimate is GDP at around 1%. So as a country, obviously, if you have 2 economic quarters in a row of negative GDP, you can find yourself in a recessionary environment. At this point in time, we are certainly reporting that that is not the case. And obviously, because you need 2 economic quarters in a row of negative growth, we have not had 2 economic quarters in a row. We have not had 1 economic quarter where there's been negative growth. So in theory, you couldn't have a recession for at least 6 to 9 months based on the economic data. So we are in the clear on that front. So the outlook for interest rates, will they go up? Will they go down? Well, it is at a, tipping point at the moment where it could go either way. Inflation is obviously still rising, but we have been able to bring inflation down from those crazy highs of 7%. It's now sticking around 4%. How do you get it to 3%? Obviously, oil is going to play a part in the what next. If oil prices go up, then of course it is probable that inflation will go up. Again, Joe Biden could fix oil tomorrow by releasing more of the world's reserve oil, and it could go down. So it's a very difficult one to forecast. OPEC could release more barrels of oil. It's a very difficult mechanism to forecast. Obviously, home building costs seem to be steadying, which is obviously deflationary or helping inflation figures. Rents, though, wow. You go to an open home, you might see 40, 50 people lining up to rent a property. And of course, that means rents are going to go up. So because rents are still rising, that is inflationary to the economy. The jobless rate is a little bit higher than where it was, obviously, at the market peak of the economic cycle. But I would think we start to see a higher jobless rate, which is ultimately deflationary, which again, nothing to be alarmed of. We won't see 12% unemployment. We might go from 4.1% to 4.4%. Obviously not nice for anyone who, obviously loses their role, but certainly we will see the impact of that being a little deflationary. Is there excess demand in the economy? Do people have money in their back pocket that they want to go burn recklessly on a lavish lunch and a designer handbag? I would say that excess demand is already out of the economy. I do not see it in the economy. That's probably anecdotal from just my observations floating around and seeing what's going on out in the world. Wages are still rising, which is obviously an inflationary thing. I think that will start to pass though, and I think we've just played a little bit of catch up there, reconciliation, so to speak. I think we'll start to live in a more steady space. Retail sales, I would say, are dropping. And again, this jacket I'm wearing today, I don't know, I picked it up. You might see it if you're on YouTube. This is a Hugo Boss jacket. How much would you expect to pay for this lovely Hugo Boss jacket? Well, you may say $250. Well, guess what? I got this Hugo Boss jacket from David Jones at $90. Yes. So retail is certainly having a price correction, and you are starting to see that excess demand. People aren't paying the prices, so the prices adjust. And of course, that is deflationary, which is a good thing. Obviously, we don't want interest rates skyrocketing. But certainly tough for retailers, I would imagine, at the moment. Strong house prices. This is, again, inflation in house prices. Property values are going up. So make of that what you will. If you want to sit on the fence and miss out on property values going up, that's your decision. But if you can get into the market, you should, because property values are going up. And of course, that is in itself an inflationary situation. So definitely steady house prices growing that are growing. Australian rates well below US, and US inflation ahead of Australia, which puts the dollar at an interesting position. Now, obviously, government debt is repaid in US dollars, so a low dollar is a bit of a negative to the repayment of debt. So do you put interest rates up to make sure that your debt burden is covered by having an Australian dollar closer to a US dollar? And obviously reconcile that way. There's an argument there for it. Definitely an argument there for it. Would we see interest rates skyrocket? No, we might see another 0.25% put into the system at some point, which also may be the peak of the situation. However, eventually rate cuts are going to come because the economy will need to find a balancing act, and those US rates could be cut at the end of 2024, and also leading to Australian rate cuts in 2024 or 2025. And again, if the US cuts rates, Australia leave rates where they are, you probably will have a higher Australian dollar. So again, there's a bit of worldwide economics at play. So the Reserve Bank's got a lot of moving parts to consider. Obviously, economic growth is certainly slower than it has been, and those new budget announcements and initiatives really, I don't think, have been inflationary or too deflationary. I think they're just real measurements of socially where we're at as a country. Is the great Australian dream dead? I might come back next week, the week after, and actually talk about that. All right, folks, thanks for your time. Let's talk again soon. That was a macroeconomic journey. Thanks for tuning in to the Urban Property Investor. To never miss an episode, make sure you subscribe to the podcast on your favorite app or on YouTube. I would love it if you could give the show a rating and share it with your friends and family. In between episodes, you can always keep in touch with me by connecting on social media over Facebook, Instagram, or LinkedIn. Until we meet again on the next episode of the Urban Property Investor, take care and bye for now.